Good afternoon, ladies and gentlemen. Welcome back to this 23rd September weekly market review. As usual, today I have my co-host with me, Mr. Gerald Wong. How are you, Gerald?
I'm good. Last week was a very big week for the financial markets. We saw the US Federal Reserve cutting the interest rates for the first time in 4 years. So that led to movements across various asset classes, which we will discuss in more detail today.
Yes, indeed. The time has come for the Fed to cut the interest rate, and those actually impacted the market greatly in some kind of a delayed reaction as market takes some time to digest the information. And of course, we have the F1 over the weekend as well. So that is also a positive turnout with the sold out tickets. But let's focus on the topic of this week today, which is the Fed rate cut, and I'll let Gerald take you through the details.
Okay, so as usual, the sharing today is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS this Wednesday, the 25th of September. We have the topic of the month being the discussion around the Fed interest rate cuts. So if you have questions around that and how it will impact various asset classes, do join the upcoming Ask SIAS and you can register via this QR code here. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this website, sias.org/.sg/membership. And as a SIAS member, you'll be able to access various online resources as well as investor education programs. In terms of the market performance for the past week, so we saw a further bounce in the US as well as Singapore stock markets. The S&P 500 closed above the 5,700 level, reaching a all-time high. And we see that that is something that is fairly broad-based across the tech stocks, as well as from the recovery that we also see for the Dow Jones. Okay, the STI went up to above 3,600 points with a 1.6% gain. So the positive momentum that we see for the US stocks has also translated to the Singapore stock market. Okay, the big news that came out was really the interest rate cut by the US Federal Reserve. This is something that has been widely anticipated, given that we have seen inflation coming down over the past few months, as well as some signs of softening in the labor market. Okay, so as we discussed in last week's weekly market review, investors have actually raised the probability of a 0.5% interest rate cut to more than 50%. And that was really what came through during the US Federal Reserve meeting, 50 basis points or 0.5% interest rate cut. And this would actually bring the benchmark rate down compared to where it was previously. Okay. The other thing to note here is that this would be the first interest rate cut in 4 years, effectively since the COVID period. As a result, a lot of investors are looking at how this will impact different asset classes. Okay, apart from the interest rate cut, what also was closely looked out for was the Federal Reserve officials' projections of interest rates. So this is reflected in the dot plot. And what we see here is that even after the 0.5% rate cut in September, the Fed officials are projecting that there will be potentially another 0.5% cut for the rest of 2024 and a further 1 percentage point cut in 2025. Okay, so in total, looking at it being cut by about 2%, and that is currently the expectations by the Fed officials. So not only are we looking at one cut coming through based on the current expectations, we are potentially looking at quite a number of further cuts over the course of 2024 as well as 2025. Okay, if we compare that to what investors are expecting, okay, so this is based on the CME FedWatch tool in terms of what traders and investors are assigning as a probability around the interest rates. Quite similar in terms of the expectation that there may be one cut in November, but then investors are a bit more aggressive in terms of expectations over the December meeting, where they are looking at potentially another 0.5% rate cut. Okay, so this will bring the potential rate cut in 2024 to 0.75%. Okay, if I look at then the 2025 expectations, we are looking at potentially 1, 2, 3, 4, 5 rate cuts in 2025, which will represent a 1.25% interest rate cut. Okay, so once again, this is a bit more aggressive compared to the Fed official projections, which was at 1%. Okay, so based on the current expectations by investors, potentially another 1.5% rate cut going through the remaining months of 2024 and 2025. So that is a bit more aggressive compared to what the Fed officials are projecting. The other thing that the Fed officials also put out would be their expectations of the long-term benchmark rate. Okay, so this is effectively where they expect the interest rate to be in the long term. And what we see here is that it has actually been raised to now 2.9% from previously 2.8%. Okay, so this is an interesting observation whereby while they have actually come out with a fairly sharp rate cut of 0.5%, and would be expecting quite a number of rate cuts for the rest of this year and 2025. Overall, the long-term interest rate is expected to settle at a higher level compared to their previous projections. Okay, so quite a number of different things to keep a lookout for apart from the rate cut that was announced. I think we do get a further update around what are the projections for rate cuts over the next 12 months, as well as where the interest rates are going to be in the longer term. Okay, we see that actually impacted different asset classes. So we start with the bond yield, since that would probably be something that has more of a direct impact. Quite interesting to me here that the US 10-year government bond actually had a bit of rebound in the bond yield after the Fed meeting. Okay, so this would probably be a result of two things. Number one, the Fed officials tried to play down the likelihood of a recession by saying that we are likely to see a soft landing. And at the same time, because of the higher long-term interest rate projection, that actually led to a slight bounce in the US 10-year government bond yield. Okay, so now we are at 3.7%. Okay, it has bounced a bit from the low of 3.6%, but still significantly lower compared to where it was at the start of September, as well as where it was just about 3 months ago, where it was sitting close to 4.5%. Okay, if you look at the shorter maturity bonds, this is the US 1-year government bond yield. We don't see a significant bounce. I would just say that it has stabilized at about the 4% level. But at the same time, we have not seen a further decline in the US 1-year government bond yield, even after the Fed interest rate cut. Okay, so that is probably something that has already been in the price of the US 1-year government bond yield, given that it has also fallen fairly sharply over the past few months. Okay, so now hovering at the 4% level. And once again, if you look at where it was just in August, it was actually at about 4.5%. And actually in the middle of this year, it was at close to 5%. Okay, so we have already seen this 1% fall over the course of the last 3 months in anticipation of the US interest rate cuts. Okay, we move closer to home to look at then the Singapore government bond yields. Okay, so interesting picture that we have here over the past week. If you were to look at the 10-year Singapore government bond yield, it has been coming down and reached a low of about 2.41% on 17 September, okay, just before the US Federal Reserve meeting. But like what we saw for the US 10-year government bond yield, there was a bit of a rebound after the meeting, and it was at 2.46% as of Friday, 19th of September. Okay, on the other hand, if you look at some of the shorter maturity bonds, such as the 6-month T-bill, then we see that it has actually continued to come down with the closing yield of the 6-month T-bill at 3.07% as of 19th September. Okay, so quite a mixed picture here, and overall, that would probably reflect the mixed signals that are being put out by the Fed, in that while the short-term rates are being cut very aggressively, the longer-term rates are actually still fairly elevated. And in fact, the Fed has raised the projection around what the long-term interest rate is going to be. Okay, so then we go to the stock market. We saw earlier that the STI actually has been performing very well given the improved sentiment towards the US market. And we saw quite a number of stocks in the STI with significant gains over the past week. And quite a number of them would be industrial stocks like Keppel, Seatrium, Sembcorp Industries, as well as Yangzijiang Shipbuilding. Okay, on the other hand, we saw the REITs giving back some of the gains. In terms of the worst performers, most of them are actually the REITs, particularly the large cap ones. And we see a bit of profit taking given the very strong move in the share price prior to the Fed meeting, as well as the move up in the 10-year Singapore government bond yield. Okay, so we have got Frasers Centrepoint Trust down by 3.8%, Mapletree Industrial Trust down by 2.8%, CapitaLand Ascendas REIT down by 1.7%, and CICT down by 1.4%. Okay, so some of the large cap REITs actually having a bit of a pullback, but we also see a divergence in the price performance of the REITs, where some of the REITs with overseas assets, as well as the REITs with a small to medium-sized market capitalization, continuing to do well. Okay, so names like Keppel Pacific Oak, US REIT, Digital Core REIT, iREIT Global, effectively the REITs with overseas assets, having a gain of more than 5% over the past week. Okay, given the pullback in some of the large cap REITs, I wanted to share a bit more about Frasers Centrepoint Trust. We saw last week that it was actually one of the top losers amongst the REITs. And what we see here is that even with the Fed interest rate cut, the share price of Frasers Centrepoint Trust has come down from above 240 to close at 227 as of Friday last week. Okay, so I went to look at their recent operational update to get a sense around how the company's performance is doing. And then we'll look also at the valuation in terms of where it is after the pullback in FCT's share price. Okay, if you to look at the committed occupancy, it remains fairly high at 99.7% as of the fiscal year third quarter 24, which is the quarter ending June 2024. Okay, so while it has come down slightly from where it was in the past 2 quarters, which was close to 100% committed occupancy, I would say that this 99.7% is actually still a fairly healthy level. Okay. On the other hand, what we have seen is actually a slowdown in terms of the shopper traffic as well as tenant sales. So if it's look at the tenant sales in the third quarter of 2024, it grew at just 0.7% year on year compared to the 4.3% growth in the previous quarter. Okay, so the occupancy rate remains fairly healthy, but we have seen some moderation in terms of the tenant sales as well as shopper traffic. If you're to look more broadly at Singapore's retail sales, the last available data would be for the month of July. Typically, we will look at both the headline retail sales number as well as the number that excludes motor vehicles. since that can effectively move around quite significantly depending on, say, things like your COE price. Okay, so if I were to look at the total retail sales on a headline level, it was still up by 1% year on year. But if you were to take out motor vehicles, then the year-on-year growth would just it would actually be negative 2.3%. Okay, and if you were to look at what is driving a lot of this decline, it'd be things like department stores, which was down 11% year on year. We have got some furniture and household equipment that was down by 5%, wearing apparel and footwear down by 10.3%. So quite a number of these more discretionary items that were actually seeing fairly sizable declines. Okay, what has been a bit more resilient would be things like your supermarkets and hypermarts, which is still growing by 1.8% year on year. So the more, I would say, staples kind of stuff where we need to be going to the supermarket and hypermarts, even if we were to see a cutback in spending in other areas, still seems to be the case based on the retail sales numbers in the month of July. Okay, if it's to look at FCT's balance sheet, the leverage is at 39.1% as of 30th June 2024, slightly up from where it was on 31st of March 2024, but still below the 40% level. Okay, in terms of the interest coverage ratio, it is at about 3.3 times, so fairly comfortable as well. And if we were to look at the average cost of debt, is at 4.2%, unchanged compared to where it was in the previous quarter. Okay, if I were to look at the valuation of FCT at this point in time, the price to book valuation is at about 1 times, even with the correction that we have seen over the past week. And this 1 times price to book will be in line with the historical average. Okay, if you look at the dividend yield of FCT now at about 5.2% dividend yield, once again, quite similar to the historical average dividend yield of FCT. Okay, so in terms of what to look out for in the week ahead, we are getting close to the end of September. So quite a number of things to look out for in the Singapore market this week. We have got the CICT preferential offering closing date. We have got the Singapore Savings Bond application closing date, as well as a upcoming 6-month Singapore T-bill auction on the 26th of September, where we'll be looking out very closely as to whether we see a further decline in the T-bill yield. Okay, in terms of macroeconomic data from the US, we'll be looking out closely for the US personal consumption expenditure data to get a further indication as to whether there are signs of moderation in US inflation. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Hey, thanks, Gerald, for that very detailed update on how the Fed interest rate cut will impact the markets and what is the outlook like for the future cuts that's coming up this year and next year as well. So for this roundup of the index on the charts, let's look at the STI index first. On this 23rd September morning, we are up about 5 points in the earlier part of the open. The markets opens earlier at 9 o'clock. It was actually up slightly a bit higher, but then you can see that the top end of today's candle, there's a bit of a candle wick over there, so a sign of a little bit of weakness over here. So the STI index is already at a multi-year high already now, and the next resistance level that I'm looking at could be the previous high at 3,641 points, and of course the upper bound of the Bollinger Band at 3,000. Let me check the numbers. 3,667 points. Those are the two resistance levels that we are looking right now. And looking at the momentum of the STI index, it has went up quite a bit, like more than 10%. You can see over here this reading, more than 10% since the low that we observed in the first week of August. So if you look at the technical readings for now, you can look at the MACD indicator. We do still have a positive MACD reading, But you can see that the MACD histogram is actually having a weaker kind of momentum reading, which means the MACD line is converging towards the signal line. So if a crossover happens, that could mean a change in direction, and this weakening of the momentum, according to the MACD indicator, signals that we could be near the peak of where this uptrend is right now already. And the RSI, looking at the RSI, the latest reading at 77 is of course already above the 70-point overbought level. So the previous time that we hit above the 70-point level was somewhere during the middle of July period, where we went close to the 78 points or even closer to the 80 points level. So similar kind of a behavior on the RSI that I'm observing right now when we hit the July high. Now in September, we are also at that level already, and we can see that we had quite a bit of a correction over there after the RSI hit above the 70-point level, closer to the 80 points level. So this is what I would want to cautious investors on in the STI right now. We are seeing that the STI reaching some kind of a peak or a multi-year high level, and the indicators are showing us that the uptrend momentum is actually weakening right now. So we will need to monitor closely in case any of a reversal formation or reversal kind of indication starts to appear on the indicators. That would be a sign that we may go into some kind of a pause on the index, or even a slight pullback towards the 20 days moving average, which is currently around the 3,512 or 3,527 points level. Okay, next let's move to the US indices. Of course, Dow Jones Index has a new record, a new all-time high, a new all-time close now at 42,063 points. So where the index is likely going to hit anything above this all-time high now, there is no previous price level guidance for us to look at. So the upper bound of that Bollinger Band now reading at 42,066 points is also very close to last Friday reading. So that also means that we have no further there's no guidance about this price level that we are looking at. The next one could be the 43,000 psychological handle. And looking at the indicators, it also shows that there is no sign of a weakening in the momentum so far, according to the MACD indicator. You can see that the last 5 trading sessions, the whole of last week, the MACD indicator reading has been expanding upward in the positive territory. That means that there could be more upside. And if you look at this bar chart over here, this histogram over here, last Friday, the volume was actually pretty high. So the uptrend was actually supported by a very big volume. And that could mean that this uptrend is actually going to be very sustainable going towards the end of the year. Of course, that PCE index this Thursday will be the key indicator that will move the market. So although the technical readings, both the RSI has not been overbought yet, we are still 4 points away. Then the MACD is showing the momentum growing as well. So I would like to tell investors, yes, momentum is all pointing towards the upwards direction, and the PCE index is something that you should be looking out for to see how high the Dow Jones Index can push higher for this year. Okay, next let's move to the broader index of the S&P 500. So similarly, the S&P 500 also has a new all-time high last week. And you can see that the MACD indicator, at least in the last 2 trading sessions, that MACD indicator reading has been expanding upwards. So that means that the uptrend momentum is intact. The uptrend momentum is likely to continue. The RSI also has a reading of 62.9. So it's a healthy reading above the 50-point neutral mark. And we still have some gap before we go above the 70-point overbought level. So there's still some room for the S&P 500 to go up higher. But as I have mentioned earlier, at the all-time high, any prices above this all-time high, there's not much of a guidance over here. And using the Bollinger Band as an indicator, the upper band of the Bollinger Band is now at 5,737 points. So that level could be where the next all-time high could be coming if we have a sort of a positive or inline expectation with the PCE index this Thursday. Okay. And lastly, let's move to the Nasdaq Composite Index. So Nasdaq Composite Index has been the lagger among the 3 major US indices. There are a few reasons. Firstly, the premium on the tech stocks now is at a very high level, and there's a rotation out of the tech stocks into the broader market, into the utility sector, into the consumer staples counters. So that also means that the Nasdaq index has not been able to sort of test the previous all-time high that we saw in July, which is at the 18,671 points level. But that it could also be a matter of time, because looking at the indicator-wise, although the Nasdaq Composite Index is a lagger, the indicators are still telling us that MACD is still recording a positive reading. That means positive momentum is still present in Nasdaq Composite Index right now. And the RSI, although among the weakest reading among the three indices at the level of 59 points, is also a very healthy reading, 9 points above the 50-point neutral mark, about another 11 points away from the 70-point overbought level. So there's still room, there's still positive momentum in the Nasdaq Composite Index as well. And it will not be a surprise for the Nasdaq Composite Index to catch up further to reach to retest the all-time high again in July at 18,671 points. So still a lot of things to look out for towards the next few months before we end the year. And the next thing that we are looking out for will be the PCE price index, because that is the Fed preferred indicator of reading the inflation in the economy right now. So we will update you again next week. So before we end, Gerald, do we have anything more to let the audience know? Of course, we have the SIAS coming out on Wednesday as well.
So I think we have had a big week for the financial markets last week. Investors are still looking at how the dust will settle after the very big interest rate cut by the Fed. That is something that we'll observe very closely as well. And likewise, the upcoming inflation data will also give us further indication as to whether we are definitely seeing signs of moderation in inflation in the US. So stay updated with us through the weekly market review, and we'll continue to update you on some of these developments.
Yes, indeed. Just a point to end this week's show. I think the data overall as a whole, the economic data and the earnings this time around, does not seem to suggest any recession coming soon. So I'm still quite positive on the markets going towards the end of the year. Okay, so once again, thank you, Gerald, for joining us today. Thank you, our audience, for tuning in. And we'll see you again next Monday on the next weekly market review. Goodbye.
Thank you.